All right, so my internet might be messed up right now, so we're gonna see. I might have to restart this and reboot.
Oh no.
Yeah. Everybody said it looks like I'm in space.
Are there people on the call, or is it just us, or is it just because you're doing like a
So
webinar version?
both people will join the call, and then it's in a Facebook Live in another group, so it just shares from Zoom into there. So a lot of
Oh,
people will
nice.
watch, maybe not as join as much. Usually I have 10 or maybe 12 people on here. Otherwise, it'll get on and just chat and talk otherwise. So that's what I was saying.
Yeah,
Oh yeah, my internet
cool.
is toast.
Um, I've always tried to I've tried a few times and not ever figured out how to live stream to Facebook or a Facebook group.
It's actually pretty easy once you figure it out. It's on the live stream option. There's like the option to do Facebook, but you don't want to do that. You want to do the custom streaming, and from there you can get some
Is that
information.
from Zoom?
Hmm. Yep. I can show you after this. I can do like a little Zoom and send it over to you. It took me a while to figure out too because I used to share. Oh my gosh, this internet's so terrible. I used to share from Facebook on like the live stream, but it stopped giving us access for groups. So
Got
we
it.
figured out this way. Man, does it sound fine to you or is it bad? Like
Sounds fine
not
to me.
okay. Because from my view, I don't know if it's Facebook maybe then. Because for me, it seems like it's fine, but it looks like it's really laggy on the Facebook side.
Got it.
All right, let me see here. I'll give it a few more minutes. I got a few people that will join the Zoom. How's your week been?
Good, man. Pretty crazy. I mean, in a good way. This time of year is like busy with end of year and holiday stuff and all that, and people want to get stuff done at the end of the year. It feels like, and then also underwriters kind of loosen their grips a little bit this time of year. So you get like business that you've been kind of waiting on for like 6 months, just all of a sudden coming through. So it's kind of nice. It's like, hey, like I'm not working any harder than I do the rest of the year, but somehow 40% of my production happens in the last 3 months.
Can't beat that sometimes. Nice
Yeah, right.
little
You got to roll with it. How about you? What the heck you been up to?
good. Just got back from Nashville from hanging out with Suter, but other than
Were you
that,
there for something else or?
yeah, I had some like conference like style training stuff was doing with some people. So meet with the
Yep.
clients.
Yep.
It was good. A little different pace than the normal like conferences or anything that we go to. So a little change of pace for things.
Yeah. Are you still selling phones or flipping phones or what are you doing right now? I mean, was that
Yeah,
always was that ever like a main gig or was that like a side hustle?
it was for a
Yeah.
while. Yeah, primarily like what we do now. We have like the custom software that we've made for the repair industry for diagnosing phones and devices, trade-ins for like customer device buyback, stuff like that. So a little bit more on the software development side, but also pretty heavy with digital marketing as well. Ad buying, uh, just designs, anything, website designs, kind of anything that somebody needs in that realm, we can pretty much handle.
Yep. Nice.
Yeah. Yep. All right. Let's see. Share this.
So yeah, I'm kind of open-ended for whatever the audience and the kind of the vibe we want to go for here, whether it's like personal and
Yeah.
like you said, kind of basic literacy and structure, or if it's like maybe a tinge of like business stuff and like LLC and tax strategy or efficiency and basics of being like a self-employed individual or small business owner. Um, Happy to kind of pivot which way you think would be valuable.
For sure. So, I would say, I mean, we can obviously just kind of like jump into just talking about stuff like you're saying, but Maybe you'll know what might be a little bit more direct or on point with, I guess, the crowd watching, if you will. I don't know if maybe, revenue area for like business helps, you kind of guide like the conversation better. I mean, we're not looking at, eight-figure, seven-figure businesses or anything here by any means,
Right.
but generally higher margin. So there is that benefit. So, most of the time I would say these guys should be seeing a pretty solid margin overall. So while it may not be a high revenue, there's pretty good net margins at the end of the day.
Word. Cool.
Let's see what we're seeing here. No, let's keep up. I mean, usually this will be like one of the more specific ones, so we might have more questions on Facebook Live that I'll kind of wait for you to die down, or I'll just throw it in chat or something. That's what I've done for
Cool.
other people. But yeah, usually we'll get like 10. It's funny. Usually there's 10 or so people that will have hop on here right after 15 minutes, like on the actual Zoom itself. But if you want to go ahead and get started and, introduce yourself, kind of like the basic breakdown of what you gave me, of what you kind of do and stuff like that.
Cool. Yeah, well, hey Josh, thanks for having me. As I'm sure my name's Drew, but a lot of people call me Andrew, whichever is easier. But I've been working in the financial services industry for about 6 years now. Ironically, before that, I was actually working in the wireless industry at Cellular Sales, the largest Verizon retailer. And so I think we've had conversations about like the crossover in that world. Did a lot of phone trade-ins, might have sold a couple on the side, stuff like that. But all in all, I got to a place when I was working in the wireless industry where I learned and I really valued how to help people and really provide value during a sale. But I realized that it was more transactional than I wanted it to be. So that kind of is ultimately what led me with some other things that happened. Life happens. It kind of leads you where you end up needing to be, and that led me into the financial services industry after about 4 years, from 2014 to 2018 is when I entered financial services. And so I kind of treaded water for a couple of years there, figuring out where I wanted to be in the industry. I was with an insurance agency for a little bit. Then when I was with an RIA, more on the investment side. And so that really gave me a good insight to kind of both ends of the spectrum. But ultimately, neither of those places were anywhere that I wanted to stick around long term. There's a combination of factors, including, the mentorship, the coaching, the infrastructure, and some of the other, leadership that was running that show that I didn't necessarily want to be around with full time or long term, I should say. So it was in 2020, right before the pandemic, when I kind of shifted to my current model that I've been running ever since, which is more of a holistic financial planning type of approach, where it's much more process driven and much more focused on primarily business owners and entrepreneurs because they have so much more going on with their financial situation that maybe isn't accounted for like it would be with a standard W-2 or employer. So for the last 4 years, that's really the space I've been working a lot in and doing a lot of education on not only the financial services industry, but business and financial planning in general and financial literacy in general. As we've invested a lot of money into education and knowledge for ourselves around business. So I feel like for me personally, that's been a really cool blend of the business knowledge and acumen combined with the financial stuff that I do and how those two worlds collide. So ultimately today, I think, Josh had asked me to come on and just kind of talk about that a little bit and what my experience has been. So Josh, I mean, I don't know that I would say that's maybe some context and some a little bit of a backstory on kind of where and how I got here. I think it's always helpful to educate a little bit on the industry itself. Because I think when you hear the term financial advisor or a financial planner or finance whatever, you there's that those terms can mean a lot of different things to different people based on what they've heard, what they've looked up, what their experience has been, maybe a story they heard from a friend or family member. So, like I kind of alluded to, there's really two worlds or two ends of the spectrum when it comes to the financial services industry. One of those being the asset management side of the house, and one of those being more the insurance and protection side of the house. So historically, you had a lot of advisors or professionals who were incentivized to sell a product, right? And maybe that product was suitable, maybe that was helpful, maybe that was valuable, but there's a lot of times where it was maybe a little bit biased in how that product was being offered or presented or sold. And so, with more recent developments over the last couple of decades, there's been a lot more transparency and a lot more accountability and regulation in our industry. And I think that's a good thing, right? Because we all see the movies like Boiler Room and Wolf of Wall Street and all this stuff where they're really kind of not painting a very good picture of the industry, right? And to be honest, it might have used to be more like that. But then, fast forward to 2008, 2009, you had a number of things happen. Obviously, we had a huge market correction. You had the whole Bernie Madoff scandal that was revealed to the public. And so that really caused a lot of reform in the industry. And so it kind of shifted at that point from being very transactional, where if you were a consumer going to try and put together your financial plan or your financial, arena, your financial situation, you're trying to piece all this together. You had to talk to an insurance agent. You had to talk to, a real estate agent to buy or sell your home or build your portfolio, the banker to get your financing. You had to talk to a CPA, and you had to talk to a stockbroker if you wanted to buy any equities, right? So all these people were in a different silo of your finances, and none of them were talking to each other, right? And so it was basically on you, the consumer, to figure this out and do your research. And this is mostly before the internet and when all this was readily available to us like it is now, right? And so that's where there was obviously a lot of room for gray area and people to be taken advantage of. So fast forward again, 2008, 2009, after that regulation happened, the next decade, obviously we saw the stock market climb, climb, climb. And throughout the course of that time, there's a lot of reform in the industry where people were held to a higher standard. They started doing financial planning, right? And so that financial planning really got commoditized. It was less of a relationship and just almost like another product offering that was a document that might have had some projections and action items on there, but it was mostly still a means to sell you whatever basket of products was on the back end, right? And so while it was an improvement, it still wasn't truly holistic, comprehensive, and coming from a fiduciary standpoint, meaning in the best interest of you, the client or the consumer. So now with the internet, you can Google any of this stuff. You can Google the stock market. You can Google Roth IRA. You can Google cryptocurrency. You can Google life insurance or any of these topics that have to do with financial planning. Should I have an LLC? Should I have an S corp? And all these different things that might come up as a small business owner or entrepreneur. And it can get really overwhelming because half of these sources that come up when you Google something are going to tell you to do it this way. The other half are going to tell you to do it the exact opposite way, or that this is the wrong way. Not to mention, there's a lot of misinformation that's mixed in there as well. So now you're sifting through like what is actually real, what is something that I should put in the garbage pile and not pay attention to, and what actually applies to my situation, right? So that's where I come in and really distill down all that information out there in the marketplace and how it might apply to someone's personal situation or business, right? And so I always think if anyone was, whether you're a do-it-yourselfer or you are trying to seek out someone that you might want to have a relationship with, whether it be a tax strategist or CPA, whether that be a financial advisor or planner like myself, whether that be a mortgage or a mortgage broker or lender, anyone, an attorney, you're going to want to look or seek out someone who's going to focus on education, right? And not just be a salesperson or very transactional or, someone, as I like to say, on the tax side who is an IRS agent in disguise, right? And so the first thing to optimizing your financial literacy or optimizing your finances is to take inventory of where you're at right now, right? And so some framework for how one might go about doing that would be to take inventory of the three parties interested in your money. So I'm trying to use the whiteboard here, Josh. I'm not sure if I messed it up, but
I'm not sure.
hmm.
I've never used it before.
Are you seeing the whiteboard on
Yeah,
your
yeah,
end?
yeah,
All
yep,
right. It's just not allowing me to draw like I intend to.
yeah. It doesn't share over on the live, but oh,
All right, here we go. So if we are looking at someone's financial picture, right? Whether you're looking at it for yourself or you're having a professional look at it, they should not be making any recommendations. You should not be making any long-term plans until you first take inventory of what's happening right now. So this circle is something you want to think about as your financial pipeline. All your dollars are coming through this pipeline, whether it be personal or business. Those dollars are going to be split up into three parties that are interested in your money. The first, I would hope, would be you, right? Hopefully you have some vested interest in your financial health and your financial well-being and your wealth. However, notice that we get the smallest piece of the pie, right? And if financial literacy was taught more and it was more well known, maybe that piece of the pie would be a little bit bigger. But that's the whole point, is how do we do that? So first, we need to understand who we're up against and what the rules of the game that we're playing by are. So if it wasn't already obvious, the first other player in that is the IRS or Uncle Sam, right? Of course, they have an interest in every dollar that we make, every dollar that we spend, every dollar that we save, depending on where we save or invest it. On the other side of the house, you have financial institutions. That could mean any banks, lenders, credit unions, insurance companies, utility companies, cell phone companies, you name it. It's really going to be any institution that has some type of process or system in place that allows them to leverage our dollars in their favor, right? So that could often look something like, all right, number one, they want to get our dollars on a regular and repeatable basis, usually monthly, right? We're making a payment to them. So they have cash flow, right? Maybe we can take a page out of their book. Number two, they want to hold on to those dollars for a period or a term of time, right? Number three, they want to charge us some type of fee, interest rate, premium, or tax, usually as high as possible. Last but not least, they want to return as few of those dollars back to us as possible. So if we know and understand this, we might have a little bit better chance of winning this game, right? And so think about it like any athlete. If we were up against an opponent, we might want to watch some film, study the game. Obviously, if we're already playing the game, we probably know the rules of it, hopefully. But if we didn't, we probably wouldn't have a very good chance of winning, right? To increase our chance of winning, any high school, college, or professional athlete is going to study their opponent. They're going to study their tendencies, what they tend to do in certain situations, etc. So if we take that same approach to our finances, we might have a little bit better chance of winning the game, right? So ultimately, our goal is how do we recapture some of these dollars that we're losing to the IRS or financial institutions and redirect those dollars back to you or back to us. Because what I find is what I observe most of the time is that, especially in the case of business owners or entrepreneurs, we are sending too much money to the IRS in the form of taxes. However, what I see as well is that in order to mitigate that or avoid that, we are setting ourselves up oftentimes to pay way more than necessary taxes in the future because we are deferring or writing off things that are essentially going to just need to be paid later. So that's where I think it's important to, yes, have a strategy where, especially if you're self-employed, I can do another drawing separately in a minute here of how you might, a very basic framework for how you might want to structure yourself if that would be valuable. But ultimately, we want to make sure that we are balancing the fact of saving on taxes now. Obviously, we don't want to pay any more taxes than we need to in any given year. We want to minimize that, but we don't want to do it at the expense of paying more than necessary taxes over our lifetime. I'll give you an example, right? This might be an overly simplistic example, but I'm sure we've all heard of a 401k and or a Roth IRA, right? And so with a 401k, people might be attracted to it because you can defer those taxes, right? You might be able to write that money off now, but if you put 5K in, you're deferring the taxes. Let's say you do that every year, and over your lifetime, that money grows to $500,000. Nice. You got a little nest egg going, but unfortunately, you haven't paid the piper yet. You're still in debt to the IRS because you haven't paid taxes. You've deferred them. Now, I'll ask the room or the audience, do we believe as a collective whole, you can nod, you can put your thumb up, thumb down, shake your head, whatever you believe. Do we believe that taxes are going to go up or down over the next few decades? Right? Think about that for a minute. Most people probably are on the side that they're going to go up. Obviously, none of us have a crystal ball, right? But if I was a betting man, I would also say probably up.
Yep.
So that's where this strategy comes in of, do we really want to be deferring all of our money? Because if and when we want to take that money out of the 401k, now we have to pay current income tax rates on the entire amount as we pull it out. So if we're age 60, age 65, whenever that is someday in the future, and now we're going to pull that money out, and all of a sudden we're in a 40, 50% income tax situation. Sure, you might be in a lower tax bracket, but the brackets might have moved up on us. So that's where the Roth comes in. It's not to say the 401k is all bad, but it means we probably don't want to be too heavily weighted in that, right? There might be some benefits to us as a business owner to have one, or if we're an employee, maybe we get the employer match or something along those lines. But if we're putting that same dollar into a Roth, the main difference is how that is taxed. Because in a Roth, you don't get a tax deduction right now. However, you are paying the tax on the seed versus the harvest. So now, let's say that money grows to that same 500,000. You guessed it. Now that is yours free and clear, completely tax-free. So that's just one example. I don't like to mention products too much, but those aren't necessarily a particular investment strategy. They're just a type of account that is taxed in a different way. I would think of it like a suitcase, right? Like a 401k is a pre-tax suitcase. You could have the same basket of stocks in the 401k as you have in the Roth. They're just going to be taxed differently on the way in and the way out, right? So ultimately, there's a number of different ways we can optimize our cash flow when it comes to financial institutions as well. We don't want to be paying any more than we need to in interest or insurance premiums. So there's a lot of ways that I find people are overpaying for insurance premiums. A simple example could be that financial literacy and good financial habits and behavior almost become a snowball effect, either in the positive direction or the negative. I'll give you an example. if you start to save some money and you start to build yourself a little bit of a nest egg and an emergency fund, you make sure you have proper cash reserves personally and in your business. All of a sudden, you can start to self-insure against some of the smaller risks that you might be exposed to. Let's say you own a car, you have car insurance or you have truck insurance on that vehicle. 9 times out of 10, when I ask someone, what is the deductible that you have on that vehicle? It's going to be $500. Most of the time, that's going to be what the insurance company would quote you at, unless you were to negotiate or ask otherwise. Now, if you go years and years and years without ever making a claim, chances are your rates might go down. But as soon as they start to go down significantly, or they're about to, your insurance company is probably going to give you a call. And rather than offering you a lower premium, they're going to offer you a lower deductible because the deductible amount and your premium amount have an inverse relationship. The lower your deductible, the higher your premium. The higher your deductible, the lower your premium. But they're not ever going to tell you that because the insurance companies get paid on premium. They're banking on you paying that premium every month, every year, every 6 months, whatever it is, and never making a claim. Because the vast majority of people, that's how it works. So we can take matters into our own hands. As long as, again, you're able to cover, let's say, $1,000 deductible. Let me back up. I usually ask the audience, all right, let me give you a scenario. You have a $500 deductible on your insurance. You just got into a fender bender, knock on wood. It's nothing crazy. You're just leaving the gym, leaving work, leaving the grocery store, whatever it is. And you've got $700-800 worth of damage, right? I don't know many cars these days that are going to get a scratch on them and be less than that. So let's just say that it was minimal damage and you've got a choice to make. You can either make the claim on your insurance, pay $500, they take care of the rest, $200-300, whatever it is. But now you have a potential risk for your rates and your premiums to go up since you now made a claim. So most of the people I ask that question, they're like, well, if it's only $600, $700, $800, I'd probably just pay it out of pocket anyways to keep it off my insurance and make sure my rates go up. And I would agree, I would do the same thing. But I would play devil's advocate in that situation and say, perhaps you're paying for an insurance that you're not even going to use or are very unlikely to use unless that damage was over a certain threshold. I don't know what that is for you. Maybe it's $1,000, maybe it's 1,500, maybe it's 2,000, depending on your situation. But if you call your insurance company up and say, hey, I'm going to self-insure up to the first $1,000, can you change my deductible? What's going to happen is your rates are going to go down. Now, I'm not saying that you should go drop or your coverage or raise your deductibles by default as a blanket statement. But what I am saying is we need to think critically around how we are sending dollars to the IRS and these financial institutions and make sure that we are not sending more than we need to. Because I've seen some people call in to their insurance company and do that one thing, and they save thousands of dollars a year, especially if they own a company with fleet vehicles or something like that. And then I've had some other people call in, and it was only going to save them like $8 a month, so it wasn't worth it. But these little things can really add up, right? It might not seem like much, but there was a study done by the U.S. World News and Report about 5 years ago, so before COVID and all this crazy inflation happened. Um, and what they found was the average American family, so it was a two-income household, but still an average American family, between all the unnecessary taxes, fees, premiums, and interest that they pay over their lifetime, plus the opportunity cost of what those dollars could have grown to over the same period, was for the average American family $2 to $6 million. So I don't know all of your financial background, but I don't know anyone who would step over a couple $1,000,000 and not pick it up. So how can we optimize your cash flow so that you're not losing this money to these institutions? Because like Kiyosaki said once, it's not what you make, it's what you keep. So how do we create that gap, right? Let's see. How can I clear this thing? guess I have to do it manually. Is this good so far, Josh? Any questions?
Yeah,
Any
yeah.
comments?
Right there at the bottom, it looks like there's a trash can that says clear. You want to clear the
Oh,
whole
there we
thing?
go.
Yeah.
There we go. All
I've
right.
never used it before, but I just happened to put my cursor
Yep.
over it.
Cool. So, I'm trying to just, spitball what would be best for the group and the
Yeah.
audience. But I think knowing that there's probably some self-employed individuals, if not some business owners that are operating at a higher level. Maybe they're kind of graduated out of the sole practitioner. Maybe they've got some employees, or at least a couple, like an assistant or something of that nature. So something that has been super valuable for me in helping just streamline cash flow, and that therefore makes bookkeeping and tax planning a lot easier, is a three account system. So if you're selling phones, if you have, whatever revenue streams coming in your business or your LLC, first thing is you definitely want to have an LLC. If you're doing anything that's consistent income, even if it's not significant income, you're going to want to protect yourself from liability, not to mention for tax purposes. And then once you have that LLC and you go to the IRS.gov website, you get that LLC on your state Secretary of State's website. You can do it for a small fee, usually $100 or less. You don't have to pay an attorney to do this. You don't have to pay an accountant to do this and charge you several $100s. You can go right on your Secretary of State website and set that up. Once you have the state ID number and then LLC established, you can go to irs.gov and you can get an EIN number. Once you have an EIN number, you can then go open a business bank account. You want to have a business bank account for any and all revenue that's generated to go into. So now you have this business checking, right? Let's say that you have $10,000 a month coming into this total from whatever sources, from one source, from five sources, from 10 sources. Um, so now you have $10,000 a month coming in to your business. Well, I don't know who has ever heard the term piercing the veil, but that is something that we want to avoid, just frivolously taking money from our business and without structure, or commingling funds in any way. So that's why we want to have a separate business bank account. And we also want to make sure there is a clear structure and strategy as to how we're moving funds from our business to our personal self, or how we are paying ourselves from that business. So I called this the three account system, right? You're going to have this dotted line, which resembles the veil, so to speak. And on the other side, we have your personal checking. Okay. And then this is your biz checking. So now, why does the business exist in the first place? Most people, I would say, probably started the business to build personal wealth for themselves, not for the business, and or freedom, time freedom, financial freedom, whatever it may have been. So that's the primary reason the business exists. So we want to make sure we are paying ourselves first. Now, obviously, the business needs to survive, and we need to keep money in the business. So we need to kind of take inventory, just like we would on our personal finances, of whatever the business expenses are per month, right? Let's say that in this case, that's $2,000 a month, whatever your subscriptions or costs are in the business. So now we have $8,000 a month left over, essentially, of profit, right? So I call this the 50-25-25 rule. It's just kind of a litmus test. It doesn't have to be your North Star or Bible, so to speak, but it can be something that you kind of start with to add some structure and then maybe play around with and find what works for you. But ultimately, this is what I started with, and it works pretty well. I'm going to take 50% of any profit in the business. Now, again, I have a pretty profitable business. I can do that. Some businesses, maybe you have to play around with those numbers or start smaller. But either way, we want to always remember that the business exists for you to build personal wealth, right? So unless there is some other way, like buying real estate, investing in your retirement, et cetera, that you can defer money or buy assets without having to pay taxes, you're going to have to move that money over to your personal. So if we're going to take 50% of the profits, we first want to make sure that we are on payroll. There's going to be a threshold, and that's not going to be applied to anyone. Let me back up for a second. As you start your LLC, a lot of the time you're just taking a draw, right? You're just moving money over as needed, or you're just moving maybe a set amount over every month to pay your bills. Let's say that's $4,000 a month. So let's say you make in your first year, you make $70,000, $80,000, maybe $100,000. After deductions, let's say you make 50K. So that's not too bad. But just by moving that money over in chunks like this and doing distributions to yourself or owner's draws to yourself and doing 4K here, 4K here, all of those distributions are going to be taxed self-employment tax, which is an additional 15.3%. Okay, so when you're starting out, the LLC is going to be the cheapest, simplest way to structure yourself. But once you're at probably around $70,000 to $80,000 or more is going to be when you want to start to think a little bit differently about how you're structuring yourself and probably start to set yourself up as an S corp. And that's going to be where you are required to put yourself on payroll. You are now, think of it like you are an expense to your own business. Okay. So you want to set your salary on payroll as something that is fair and reasonable. And this is a way that you can really control how much you're paying in tax. Because if you're going to pay yourself 100 grand out of your business because your business is growing and flourishing and it's successful, well, now you're going to really pay way more self-employment tax than you need to. So how do we limit that and maybe tamp that down a little bit? Well, that's going to be by filing as an S corp, right? So now you put yourself on salary. How much should you put yourself on salary for? Well, that's where a personal budget comes in. And for anybody who doesn't already have a personal budget, obviously you can do something on paper. You can make a spreadsheet if you want to do it yourself. If it would be valuable for anyone in the audience to have that resource, Josh, I can email out a template that's all kind of pre-done for a budget and kind of cash flow worksheet that includes line items and memory joggers like rent, pets, children's activities, entertainment, whatever. So you can kind of go through and get inventory of what your personal expenses are, right? And it's not to say that I'm not a big believer in a budget to say that you're gonna follow it to a T. In that sense, budgets are garbage. Nobody's gonna follow them. But what they are valuable for is every 3 to 6 months or so, taking inventory of where you're at from a monthly burn rate. What do you need personally, or what does your business need to survive? If you're a business owner, you should be doing this monthly at least, if not weekly or bi-weekly. But on the personal side, there's probably not as much variability. So let's say that your bills are 4 grand a month. We're using simple and small numbers here, but if you have bigger numbers, the same thing would apply. Just apply it to your situation. Now, if your bills are 4 grand a month, you need 4 grand a month just to survive. We want to treat your future self as a bill. So we want to add 20%, at least 15%, but ideally 20% to whatever your bills are so that you can also pay your future self. So because we should be treating savings as a bill. So that would mean if we're sending 20% or in this case, $800 over to savings, then that means we actually need to make our salary $4,800 a month. Okay. So now we have $2,000 in business expenses. We're paying ourselves $4,800 a month, which means total expenses to the business are now $6,800. We're going to round up to 7,000 because of payroll taxes. So you've got 3,000 less left over. All right. So what do we do with that 3,000 left over? Well, that's where the 50, 25, 25 rule that I mentioned 5, 10 minutes ago comes in. We're going to let's say a month, we're going to let a whole quarter go by. So 3 months. So now we're going to have 9 grand that has stacked up in the business checking. We've also paid ourselves along the way, and we've paid whatever tax deductible business expenses that we have. So now what do we do with that 9 grand? Well, you can decide as a business owner how often you do this, whether it be every month, whether it be quarterly, or whether it be annually. All businesses are different. But when you do this and you decide, hey, what are we going to do with our profits? I think the 50, 25, 25 rule is a good litmus test. So first, you're going to take a 50% distribution to yourself. So that would be, in this case, 4,500 bucks. So that's like a nice little quarterly bonus for you. And the beauty of that is not only do you get a bonus, but it's going to be taxed at a lower rate because it's not part of your salary. That's the other kind of key ingredient here is that your salary is in the S Corp, the only portion of your income that is going to be subject to that self-employment tax. So now we're really limiting how much you're going to pay there. And then your big checks that you want to bonus yourself out, you do via a distribution outside of your payroll so that they are not subject to those self-employment taxes of an additional 15.3%. So as you're making anything over 80,000 or especially 100,000, that's going to save you a bunch of money on taxes. Now we have $4,500 left over. We're going to take 25%. So let's say, 2.25 thousand, 2,250 bucks, and we're going to put it in a capital account. You could have this be a business savings. It could be another business checking. It doesn't matter. The point of this account is to intentionally and proactively reinvest back into your business. A lot of business owners, they are just figuring it out along the way. And, we are very good at that. We always find a way, we figure it out. But as you kind of get out of that startup phase and start to, you want to be a little bit more mature as a business owner and kind of be a little bit more strategic, setting aside these capital funds is going to allow you to invest back into your business in things like marketing or hiring or whatever it may be that's going to help you grow and scale and get more exposure in your business and therefore generate more revenue. Right. And then the other, let's say $2,250, you're going to leave in that account just for operating expenses that may come up. Right. So that's some framework. Hopefully that was helpful as to how you can start to structure yourself a little bit better as your income increases. The S Corp is going to serve you pretty well from what the S Corp is going to serve you pretty well from my experience up until several $100,000. Like probably at least the $500,000 to $700,000 range, because that's going to allow you to write off IRAs, defer up to $70,000 a year in a SEP or a or a solo 401k. You can start to buy real estate. There's a number of different ways from that, let's say 100,000 up to the upper six figures. Once you're into the upper six figures, that's when it gets a little bit more complex. You're going to be talking about multiple LLCs, holding companies, possibly even S Corps and C Corps. So for today, we're going to keep it pretty simple. But we want to have, when I ask people what the most important resource they have is, their answer usually includes time and money. But they don't follow a calendar and they don't have a system for their money, which I find ironic. So if it's important, we need to have a system. So hopefully this is giving some foundational principles for how you can start to put that system together. So now that you have some basic structure for how you can, position your accounts, I kind of mentioned it, But I wanted to maybe make sure it doesn't get glazed over. Um, this could apply to especially personal, but it could also apply to business. I find that in how people handle their cash flow, there are three different types of people. And on this spectrum, there is on the left, financially dependent, on the right, financially independent, or at least on the way to be. So this does not indicate someone's income, or it does not depend on someone's income. It depends on how they treat their income. The first group, if they're financially independent, the income comes in, the expenses go out, there is no or very little savings happening, let's say 0 to 2%. And so if they miss a paycheck, they are financially dependent. They are not, life's not very fun very quickly, right? There's no reserves, there's no room for error. If we miss a paycheck, things start to unravel. Then you have the middle group where I would say most people fall into, um, especially a lot of celebrities, athletes, high income earners that we see. Once they're out of the league, they're out of money really quickly, and that's because they didn't have any structure, right? They had income coming in, they had expenses going out, and they were fortunate enough to have some money left over at the end of the month or the year or whatever, where they're able to save. But it was saving by default, not by design, right? So they're probably only saving or maybe putting away 5 to 12% of their income. And this is gross, by the way, not net. So, one, it wasn't proactive, it wasn't structured, it wasn't by design. Two, even if it was, it's not enough to get us to financial independence. There's an adage in financial planning or in the industry that says, hey, if I save and invest 20%, we can't just save it to a bank account or a savings account, right? But if I save and then ultimately invest 20% of my income over 20 years, I should be financially independent, meaning that my assets could provide me at least 70% of my earned income passively. So how do we get there? Well, I just said it. We got to make sure we are putting away 15 to 25% of our gross income. But in addition to that, we want to make sure that it's structured. And here's why. Income comes in, we're treating savings as a bill. It comes out first. Literally, I'm on payroll for myself and I'm my boss and my employee. So when I get my paycheck, 20% goes into savings. Every time that hits a certain amount, that goes into a high yield savings where it's out of sight, out of mind. With the difference after it's already gone into retirement and everything else, I've already invested back into my business. The difference is my spending money. And that's usually where I'll, maybe buy some crypto or some stocks if I want to do that and play around with trading. But that's after and outside of my savings rate that I include, in my financial plan. But regardless of how you think about that, regardless of if you go, spend the rest, that's the beauty of it is you've already checked that box and the rest is yours to discretion, your discretion. You go, I don't care what kind of car you drive, how many times a week you go out to eat, how many trips you go on, as long as we are hitting this 20% or at minimum 15. If you can't start at 15 right now because of your situation, start somewhere. I would much rather see you intentionally saving in a structured way, 10%, than try to do 15% and only do it once every 3 months, right? So now we're going to run into new problems. We start to actually put some structure in place and actually pay attention to our cash flow and actually start to put some money away. We're going to run into, okay, now where should I put it? Should I go all in on Bitcoin, Solana, Nvidia, Tesla? Should I put it in a Roth IRA? Like what comes next? So I'll give you guys one last little, drawing here, and then I'll pause for questions at the end. if anybody, is stuck around this long. So let's say now you're doing the thing. You're doing the 80/20 rule. You've got 20% going to your future self. You got 80% going to lifestyle expenses. I would never discourage anyone from doing more than 20%, but for this example, that's what we'll run with. Depending on your goals, you might want to be more aggressive, or if you're behind, you might want to be more aggressive. But either way, no matter what this ratio is, the point here is whatever goes to lifestyle, it's gone. It's out of your financial arena forever. You're never going to make another decision with those dollars ever again. A lot of people, I think, they maybe don't proactively save or intentionally save because they don't really know why they should. So it's hard to overlook that short-term, instant gratification for that long-term gratification because you really can't see the forest through the trees and say, man, when I do this, it's going to lead to that. So maybe this will help you with that roadmap and with that visual a little bit. Because once you start putting away this 20%, now it comes to diversification. Now, there is several layers of diversification. We all probably know, we shouldn't have our eggs in one basket, as they say. That could include asset diversification, meaning real estate, stocks, bonds, crypto, business, and then within each of those asset classes, we can further diversify between single family, multifamily, residential, commercial, large cap, small cap, mid cap, multifamily, in a floodplain, on a top of a mountain, all these different things. Secondly, so that's asset diversification. Second layer of diversification would be tax diversification. The third layer that I'm kind of presenting right here is timeline diversification, or as I otherwise refer to it, layers of liquidity. So you want to start, once we built this habit of putting money away, now we want to start to build an ecosystem of different buckets and levers that we can pull from in the future. So the cool part is that we are ultimately going to make another decision, if not several more decisions, with these dollars that we start to put away. So the first, you got to start filling up that short-term bucket. You got to have some cash and cash equivalents. Then we can get to the medium term and the long term. So what does that look like? Well, first, you're going to want 3 to 6 months of expenses, bare minimum, so you have a little buffer. Right? So how do we know how much that number is? Well, first you got to have a budget. You got to know what your expenses are. Point in case to the last one. If you don't know what your expenses are, you don't know how much you should have to cover 3 to 6 months of expenses. You're just guessing. So we'll go off that same number of $5,000 a month. That would mean you're going to want to have 15 to 30K in savings or in cash. Now, that's a solid place to start. The optimal amount, and this might be a bigger number, but optimal is going to be 6 months of adjusted gross income. So if you're making 160 grand a year, well, let's say 100 grand a year, that's going to now be 50,000. And you might think, wow, that's a lot of cash. I'm losing money to inflation. Why wouldn't I want to invest that? And I'm not saying that we should only save the cash until we hit 50K, if that's you. What I am saying is that's something that is optimal. That's something that we want to get to over time, right? Because that's not only an emergency fund, it's not being super conservative. It's also an opportunity fund. So that when COVID or 2008, 2009 happens inevitably, again, we have a recession, you're in a position to take advantage of opportunities and buy up assets for pennies on the dollar. Right? So until you have other assets that you can liquidate or borrow against in situations like that, you want to keep a good cash reserve, not only for emergencies, but for opportunities. So again, I'm not saying that we should wait until we have 50K in the bank to start investing. Well, what I am saying is that we want to continue to swim towards that 6 months of adjusted gross income. Now, once we're at that, 3 to 6 months or close to it, that's when we can start to peel off part of this 20% for the long term. We want to make sure we have protections in place, things like life insurance. You're never getting younger. It doesn't get any cheaper. It gets more expensive every year. So you're kind of a knucklehead not to get it when you're young. You're just going to pay more than you need to. So even if you don't have a family, even if you don't think you need it, there's a lot of things that you can lock in for the long term when you are young and healthy and your situation is relatively simple. Outside of that, you're going to want to get the long-term bucket on autopilot, right? We want probably 15 um, or at least a portion of our savings rate going to that long-term bucket, aka retirement, because that's the biggest, longest vacation you're ever going to have to prepare for or save for, and we can't finance it any other way. We can't take a loan out for it. So you see this bucket split in half, right? That's because there is a safe side and a risky side to it. The risky side is where we want to have growth. We want to, have that Roth IRA or 401k or maybe a SEP if we're a business owner. Whatever it is, maybe it's a split dollar plan if we're a higher income earner. Either way, we want to be able to defer some money, maybe have some tax-free money growing there. But we understand that with risk comes reward, and we're going to get the most growth there for the long term and outpace inflation. On the other hand, though, we're going to want some leverage. We're going to want some stability. These could include things like pensions. But we all know when we hear that word that they're largely extinct. Hardly anyone has a pension anymore. So an annuity might be another vehicle. A lot of pensions, believe it or not, were actually built on annuities or by annuity companies. And it's not something that you probably look at when you're younger, but as you get closer to that phase of life, it can be a way for you to create a guaranteed income stream for yourself that you will never outlive, that it can at least cover your fixed expenses. Then last but not least, you have whole life or permanent life insurance. That gets a lot of mixed reviews, and I think that's mostly because of a lack of education or because it's oversold or sold by the wrong people who don't actually understand what they're selling. So whether it's whole life, universal life, or variable life, that can create a stable asset that's really going to be kind of a backstop in the Swiss Army knife of your financial plan. Now, outside of product, the point is here that once you have that short-term money, you got a solid little reserve. Now you have your long-term money kind of on autopilot. You set it and forget it. You're maxing those out. You're making automatic contributions. Now you've kind of given yourself permission. You see this little dumbbell emerge, right? Now you're kind of giving yourself permission to take a lot more risk and be a lot more aggressive in this midterm bucket, right? So that could include any brokerage or advisory accounts in the stock market or crypto or business or real estate. And maybe you don't follow this exact order of operations, but regardless, you want to take inventory of, hey, I have some short-term money. Like, this is money that I'm going to want or need access to in the next 12 to 18 months. This long-term bucket, I'm probably not touching that for 10 plus years. This midterm, it could be anywhere in as little as 2 years all the way to 10 plus, but we don't have to hold it at long, right? So this kind of gives us a lay of the land where, once we start building that habit of putting money away, where it might start to go. So I know I've done a lot of talking there. Hopefully, that kind of strung together into something that was cohesive and helpful. But Josh, anything else that you would add or think that I should elaborate on or anything like that?
No, I think you killed it. I
I'm
mean,
trying to
like I said,
unshare now.
like I said in the chat, that the one of the best comments was, "Oh, my video's gone now. That's crazy." There it is. He's like, "This dude's putting people on game." So that was again, you were dropping the right knowledge. Like I
There
said,
we
a lot
go.
of this
Now I can see you.
awesome. Yeah. So no, I think you're
Cool,
good. You
man.
covered
Awesome.
everything.
Love to
So
hear it. Hey, I'm happy to, build off this. I'm happy to do another one. I'm happy to talk with people offline. If they had personal questions or if there's like a Q&A here. I know You said this typically finishes up around an hour, so I want to be respectful of everybody's time, but I'm happy to hang out for a little bit if there's questions.
I don't have any. There's none in the Facebook Live yet. A couple people are liking the S Corp stuff. They said they just had converted to S Corp, so they said you were right on point there. But other than that, one guy was asking how to hire you.
Well, we can talk about that. I mean, I yeah, I mean, the short answer is I charge an annual fee and we work together as a team. It's not just like, hey, let me sell you some insurance or get your money in the stock market. It's like, hey, let's actually make a plan. How does that, include your business or whatever other assets or things you have going on? And we can figure out that if that's a good fit or not. All my first conversations are always complimentary, get to know each other a little bit, and even if it's even going to make sense to work together.
Awesome.
Tony, I see you camera on, mic off or mic on. I appreciate you chiming in, watching. You were nodding along the way, so it felt like I was actually talking to somebody besides Josh.
No, it's all. I'm here. I'm a veteran, so I'm with Josh every time. You see,
Oh, sweet.
when they go low, we go high. I gotta support my guy here.
Yes, sir.
Now
Well,
it's crazy because every Friday there is like 8 to 10 people, so
I
he's
know.
in line about that. But
Uh,
just today, I guess I guess everybody's busy, which is good because holiday
we had
season
a
is
lot
here.
of people. We had a lot of people on Facebook Live though. So
Yeah.
it was a trade-off. So there was a lot more people in there than there usually is. So there just
Okay.
wasn't as many people in here chatting it up like other times.
You see, Andrew, I don't try to I don't try to absorb what you said because I'm the kind of guy, if I don't know something, I gotta hire a guy that knows. So
yeah, no,
I
I say all the time, I say some of my clients, they want to know how the watch is made. They got to know every little gear and trinket in there. Some of my other clients, they just say, tell me what time it is so I can keep on going.
exactly. I'm that guy. I'm that guy. I believe that there's, if I try to know everything, then it's you're gonna be overwhelmed with information. I'm
Yeah.
that kind of guy. I think that's why when you were talking along the way, I'm chiming in, I'm listening, but then I'm not following. Like if you ask me a question, what did I? Because it's you know what you're talking about. That's very important because the way
Yeah.
you're represented it and you're saying it to people, and it says a lot about your personality. And my best advice, if I really have to touch on what just happened, is if anyone wants to go to the next level and make sure their paperwork is done properly, just hire the right person. And if you do take jobs like this, then they would hire you for that.
Yeah, for
Absolutely.
sure. I got a couple licenses. Not too many letters behind my name just yet, but I got all the licenses to show. So
It's
definitely
the
not just
paperwork, man. As long
yeah.
as you have your papers, if you're playing your cards right, I think it's very important in any kind of business. It could be a restaurant, it could be an ice cream shop, whatever it is. It doesn't have to be a cell phone business or a commercial or properties or anything like that. As long as you have your cards stacked up right, you can
Yep.
go a long way in this country.
For sure, man. And like you kind of said, maybe without saying it, I mean, I might be a little bit biased, but don't give your money to people that don't have a license because a license means accountability, right? It means that they have something to lose if they don't do what they said they were going to do with your money. And if you are going to invest with someone without a license, without credentials, then do your homework. Ask for, reviews and results and stuff like that. Because Josh and I, maybe you too, Tony, have been in some circles where people didn't deliver on those promises. And the it's I would say the financial planning is one of the biggest things is preventing the losses just as much as creating the wins, right? Because when we go backwards, it hurts. So if you're going to give your money to anybody that doesn't have a license, make sure you know them, make sure you've done your homework. And even when they do have a license, doesn't mean that by default that they're great. So yeah, I think I said it in the beginning, but I think a couple traits that are valuable are like, hey, are they education based? Are they going to actually tell me what's going on? Like that, maybe Tony, like a lot of people are like you, they don't want to know every detail, but I like to say, hey, if somebody has something through me or is doing something with me, I want them to at least have an idea why.
You know the way I don't know if so since 2016 2017 I've been creating this Tony talk show. It's very similar to
Okay.
this, but I'm not as smart as Josh where I can tune in, zoom into the group. So I was doing the live videos since 2017. I could not stress enough to tell people to pay themselves a payroll. One of the biggest problems that I've seen in my industry, let's put it this way, in the wireless industry for now, is a lot of cell phone store owners do not pay themselves a payroll. So if you would go to someone and their store is doing 15 to $20,000 in revenue a month, and you're asking them how much profit you're making, they would tell you $5,000. Now, who's working in the store? Me and my wife. Do you pay yourself a payroll? No, we don't. So if you're actually paying yourself a payroll between you and your wife, you're probably upside down $2,000 and you're making zero profit. So when a lot of people come and value their stores to sell their business, and they're saying, "Oh, I'm making $5,000 a month." Well, let's talk numbers now. Are you paying yourself? Are you paying your employee? How many hours a week you're open? Things like that. But again, I'm not that my I can advise them based on my retail and my wholesale and my managing experience.
Yeah.
But overall, it's just, and that's one of the biggest problems that I've seen in the past, I would say 10 years being involved into this industry. Another thing is, when going back to hiring the right person, yes, I do not ask questions. Yes, I would tell you here it is. But one of the things that I do is I probably do a full inspection, randomly. And I don't want to you don't want me catch you slipping on my paperwork because I trust you, but then
Yep.
I will ask advices outside of my circle because and that's one of the things that I've done with a lot of vendors or people that I've done business with. Yes, I'm going to trust you. Yes, I'm going to ship you product without you paying. But don't give me the reason if you're not paying. Let me show you what I can do about that. And
Yeah.
we'll burn down bridges. But it's very important to have the right people in place, especially for money and taxes and paperwork. Those things you don't
Yeah.
want to be caught slipping.
Yeah. No, now you're bringing up another good point that I always talk about is that 90% of the time, I would say, people, meaning financial professionals, whether it be a financial advisor, a life insurance guy, an attorney, a tax, strategist or preparer, or a lender or broker of some sort, they're all operating in a silo, right? So they might be trying to help you, but they're not looking at the whole big picture of what you got going on financially. They're trying to get your money in the market. They're trying to get that deal closed. They're trying to, get that agreement written up and get it over with or whatever it may be. And so oftentimes that can cause a lot of gaps and inefficiencies between these different silos because everybody's kind of looking at their own thing and they're usually not on the same page. Because I'll ask people, when was the last time your accountant, your financial advisor, your insurance guy, your attorney, and your real estate agent or mortgage broker or whatever all got in the same room or on a call to figure out if their advice is actually in your best interest or not? And the answer is no, that hasn't happened ever.
When you got my attention, you said one thing that really got my attention, and I can probably already vouch for you, even though I don't know you. You said something very important. You said, "I need to get to know you. We have to make a few phone calls to get to know each other. My job is to pretty much become a partner to that person. You know what I mean?
Yeah.
So that's priceless. To me, that is priceless.
Awesome,
You
man.
can ask numbers and that itself right there would show that you are you're a challenging person. You like to grab things that's probably unstable and make sure it's stabilized and grow with it and then come back to your client and say, look what I did.
Yeah, now let's simplify it. Let's
Yes, yes, yeah,
yeah.
and that's very important. I mean, honestly, it's it shows that you care for every customer. They're not just numbers, and it shows that you like the challenge and you like a puzzle, and you just want to make sure everything is in the right place. And that's very important. And that's very small detail that probably got my attention. And I promise you, if I don't have a CPA or if I manage my paperwork, you definitely hired by me. Absolutely, 100%.
Well, I kind of I wouldn't say I'm in the same arena as the CPA. I more or less hold their feet to the fire and make sure that they're doing all the things that they can be, rather than just telling you how much you owe. But no, I appreciate that, man, because yeah, it's so true. Over the last 4 or 5 years, I've gotten much better at when a client might be like, hey, going on pause, or maybe they're not as bought in as they were originally. And to your point about caring, I probably cared too much in some instances, like more than they did. So now it's like, hey, we find that happy medium, and those who want to, want it for themselves, we can create a pretty good partnership going forward.
So you're pretty much a financial advisor. Let's put it
Yeah,
that way.
so here's my take on financial advisor versus financial planner,
Okay.
because I consider myself a financial planner. A financial advisor is someone who's really focused on that investment strategy. They're going to be focused on, hey, what dollars do you have in the market? That's how I get paid, is what you can invest, right? I'm going to charge that 1% or whatever it is, and I'm going to grow your money. It's going to be great. Yes, I do that, but my focus is not primarily that. I'm looking more holistic. What is the planning strategy and everything that's attached to a dollar in your world, including your business, real estate, invested assets, cash flow, etc., so that we can really make sure there's no stone left unturned. So rather than just being paid to manage somebody's assets or sell them a life insurance policy or whatever it may be, I just charge an annual flat fee that's custom to that person's situation. Usually that ranges like 2 grand to 5 grand a year. Sometimes it's more for the business owners, or the more complex situations if there's like multiple owners and stuff like that. But that would probably be into the 7-figure range, right? If it's over 5,000 a year. And that's where we're really, to your point, creating that partnership, having proactive trimester or quarterly meetings, so that I'm incentivized to give you good advice on an ongoing basis, not just around your stock accounts, right? Because everybody says, oh, I'll do that part for free, but they're not going to be delivering a high level of service or experience if they're not getting paid for it. So, not to mention, I'm paid outside of just rushing to a transaction or a sale and getting your money in the market. So it creates a lot more of a, like you said, a partnership, a team effort, rather than a tug of war of like, hey, I want to invest my money into real estate or my business, and this guy's trying to get me to put it into an IRA. Like, yes, those things are important, but what is the strategy and why are we doing it? Because if it doesn't have a specific purpose in the plan, then we shouldn't be doing it. And if we can't name or say or describe what that purpose is for whatever we're doing, then there isn't one.
Makes sense. Makes sense. No, I
So,
mean, you have to be passionate about what you're talking about. I mean, the way you talk about it, it's kind of like me when I talk about phones.
fair
Tony,
enough,
Tony, did
man.
you hear him earlier say he worked for Verizon, like Verizon franchise before he did all
No, I
this?
probably tuned
Yeah,
out.
Yeah,
yeah.
I was at Seasaki from 14 to 18.
Wow.
Cellular sales of Verizon. Yep. So I
It's
was
a
in
tough
the wireless
industry.
industry for a bit.
One of the things maybe I can ask you or recommend people to you, you have to walk into this industry knowing a few things that are very important. One is a lot of them, and this is no offense to my people or to my store owners, a lot of them ball on a budget. Okay. So our industry is very nice. It's pretty cool. But it recruits a lot of hustler mentalities. Okay. So a lot of us like to take shortcuts,
Yeah.
knowing the fact that when we took shortcuts, we made quick money. And yes, there is quick money to be made. Now, the only problem we probably forgot to think about is short money and fast money is not consistent. Okay. So you could be here one day and then you could be here another. So I think going into this industry and probably get hired by some of cell phone repair shop owners or somebody's in this industry, take this with you that, you know, if your cost is somewhere a bit high, they will not hire you. What I would recommend is go, you know, with a budget for them and get as many people as you could.
Yep.
Because I can guarantee you there's 60 to 70% of cell phone shop owners are struggling right now.
A lot of people are struggling right now.
It
Yeah.
is, and especially in our industry because nothing has, you know. So you said since 2014 to 17 or 16, has an iPhone changed since?
Yeah.
No. You could probably talk about an iPhone right now, and I can tell you that the newest iPhone has all these
Right.
features, and nothing changed. So, you know, our industry took a hit when a lot of that happened. So a lot of the people that are doing repairs are doing okay, but you cannot get wealthy from doing repairs because you need more
Yeah.
hands, and more hands requires, you know, payroll, and
Yeah, it's
more
just less
payroll
scalable.
exactly. And everyone is making 10, 20, $30 profit on advice. How many devices you're going to do a day to make $200-300?
Right. Yeah.
So that's take that
No,
into
absolutely, man. I
consideration going
appreciate
into.
it. I like to be honest and forthcoming about my fees or costs, but I absolutely don't want that fee to be a barrier of entry either. So I'm with business owners, whether it be solar or cellular devices or wireless or whatever, you know, I'm flexible on
If
that.
anybody
I
wants to
have to
hire
tailor it.
Andrew, make sure you send me $50 for that discount you just got.
Yeah, he already did the negotiating for
For
you,
the
right?
whole industry, right? Yeah,
That's
yeah. I mean,
Love
hilarious.
it, man.
you know, part of the reason, you know, me, probably Josh, and other people that's been in the industry for a while, you know, I think more of what we do, you know, look, Josh is taking an hour and a half out of his day every Friday, same here, just to give back and bringing
Yeah.
you on board and bringing other people on board. You know, I could still do my work while I'm watching, while I'm advising, but I'll chime in 10, 15 minutes, pitch what I can. And probably for a lot of people, it's a surprise that I'm quiet for a whole hour on a video call. I am not. I'm usually you
Yeah.
on every call.
Yeah.
But this time, you know, like I said, I don't speak about anything that I don't know of. I would hire someone that knows about it. So
Love it.
what I do is I know how to push sales. I am in the retail industry, and I am in the wholesale industry, and I am into other industries as well. So I can speak and advise. And probably what motivates me the most is seeing the results on people that I
Yeah.
advise. You
Oh,
know, if I
absolutely.
advise you and I see that result for the past 10 years, then I must be
Little
doing something
selfish
right. Like a
pleasure
lot of
right
people
there.
come in.
Yeah,
Yeah,
for
yeah, yeah. A
sure.
lot of people come in and say, you know, wow, your price is very high. Well, I must be doing something right, and you're
Yeah.
doing something wrong. You know what I
Yeah.
mean? So you gotta weigh your options here.
Yeah, for sure, man. Love it. Well, hey, it was a pleasure meeting you, Tony.
Yeah.
Likewise, man.
I'm a
Appreciate
Thanks
it.
for
hop
coming,
off. Josh,
man.
yeah, thanks for having me, man.
Appreciate it. You have a good weekend.
As
Yeah,
absolutely. Hey, you guys too. Happy Thanksgiving.
same to
Yeah,
you.
you too. See you. All
Damn,
right.
Thanksgiving is right up the corner.
I know. I know.
Shit.
Definitely is.
Well,
Awesome.
we
Well,
had any? Did you have any questions or?
there was a few people that had questions, but I mean nothing crazy, like stuff that I'd already like mentioned to them. So, um, again, it all comes down to being a matter of having being seeing and knowing this stuff, right? Like there's a lot of guys who just don't know anything about this. They are truly just winging it. So as much
He's pretty smart. I'm not gonna lie.
yeah, he is.
Yeah, he's pretty smart.
Yep. So
I mean,
yeah,
like you
I
said, the
figured
way
it'd be
he
good.
pitches things is it shows that he's passionate about what he talks about. You know, I I found myself usually tuned out when when it comes to conversations about financials,
Yeah.
due to the fact that I do not manage any of my financials in my companies.
Yeah.
So possibly, one of my partners, if he hears him, he would have. I should have told my partner to jump in, or I'll have him watch it probably later
Yeah,
on.
you can do that. And he said he'd come back on too. I'm thinking about having maybe come back on and just like maybe try pushing it a little bit more in advance, try getting people to have some questions for him and stuff like that, right? Kind of
Yeah,
sucked for him that we had a low turnout on here like we usually do, but it's whatever. People seem like they definitely got some feedback, good feedback from it. So, but he said he'd come back on, and somebody else want to know a couple other things, and I've got a guy that kind of works with
do you
him as
have his
well.
contact information for people to hire him?
Yeah, I'll put it up, his email and stuff like that in the comments and stuff like that, and then in the group on the event. But
Yeah,
my goal would be to get him back on again. And I've got another guy who it's not, I wouldn't say necessarily a huge thing for this industry, but I know there are some maybe bigger operators that do other things outside this industry, like yourself, right? You're doing more than just this industry. So you're investing in other stuff. This guy's big into like business capital and stuff like that, and kind of teaches you how to build your business credit or just like understanding like that and like that side of it. So you're not always worrying about your own personal credit. So I think there's some benefits there
yeah.
that he could drop and they can kind of, pair off of each other even.
It is. It is very. I think that it's very important to, like he said. He said also another thing that got my attention. He said it twice. That he don't put all your balls in one basket. That's something I always say. And that's one of the reasons why I spread my incomes in because you never know when
Yep.
1 month. And right now, like I said, 1 month your monthly sales are down, 1 month is up, 1 month is down, 2 months are up. So having different sources for income is very, very important. I think it's also very important when and where and to trust who when you're investing outside the box. You know what I mean?
Right.
A lot of people. I just a bit ago seen a post from Nicole Russell, um, talking about her ice cream business. I didn't know she had an ice cream business back in the
Me
days.
neither.
Uh, she said that this was a business she lost $40,000 in, having the wrong partner. You know what I mean? So you got to understand, like I said, who, when, and where, and what to invest in. If you have a little bit of cash to put into a second income, why not? I'm with a second income, but you just got to know what it is. Like, do you really want to open another business that does not survive without a business owner, or do you want to open another business that can survive with anyone? Like
Yep.
look at Wawa gas station, racetracks, these big gas stations. Just they're putting machines in. People are
Oh
cashing
yeah.
out. Walmart, all that stuff.
Yep. Agreed. My video was acting up and everybody said we're looking like we're buffering like the Netflix fight. So
Oh, both of
probably,
us?
yeah, but it's probably because of me. I disabled my video for it. But
Okay.
yeah, we'll probably just end it,
All right.
and then won't
We'll get
won't
a
be
better
meeting
internet
next
by
week.
next week.
Yeah, next week we won't be meeting. It's
Oh,
I
yes.
mean maybe
Thanksgiving.
everybody
Oh,
will be
Black Friday.
busy. So
Yeah,
yeah,
that's true.
we'll skip it.
Well,
So
have a good weekend, man. Enjoy
hey, you
your
too,
week,
man.
enjoy family time,
Appreciate
and
everybody joining.
yeah, we'll be in touch. Happy
Yep.
Thanksgiving,
See you guys.
everyone. GSM Warehouse Black Friday sale.